Hey everyone, welcome back to the Wealth Hub IQ. Who doesn't want to make money while they sleep? Today we're diving right into the world of investing for beginners. So let's get to understanding the basics of investing. Now I know what you're thinking. Investing sounds complicated and scary and something that you just want to let the finance guys handle. Well, we're going to change that idea today and we're all going to be empowered. But don't worry, it's not as bad as trying to assemble an IKEA furniture without the instructions. Basic investing is much more simple than that. So what is investing? Investing is all about putting your money to work so it can continue to grow for you over time. Think of it as planting a money tree. You water it regularly and eventually it bears fruit. Simple, right? The stock market, bonds, mutual funds, or even real estate. These are just a few of the many ways you can invest your money. Each one has its pros and cons, but the most important thing to remember is that investing is a long-term game and not a get-rich-quick scheme. It's about patience and letting your money grow over time. In fact, there's a very popular saying that it says, the best way to invest is to have time in the market as opposed to trying to time the market perfectly. So they say the saying is, it's better to have time in the market than have time in the market. And what that basically is saying is that it's better for you to continuously invest in the market for the long run than waiting in that long run and trying to see the perfect time to get into the market, because there would never be that perfect time. And because of compounding, it's better to have time in the market. And the gains are very clear as well. If you start investing from as early as possible, you see the compounding gains that continue to go throughout. Since we're in 2024, let's also throw out cryptocurrency. Digital assets are also a huge way that investors can now grace the investing market. And as a whole, cryptocurrency is something that a lot of people do understand. So I must mention that that is in fact a way to invest for beginners as well. Please speak to a financial advisor before taking on any investments for yourself. Next up, let's talk about where to start, because a lot of people get so frazzled with the thought of, should I start here? Should I start there? Should I start later? Should I start now? You don't need to be the next Warren Buffett, and I must say this, or have a small fortune to get going. I remember there was a famous quote by Donald Trump where he said that his dad helped him with his initial investment by giving him a loan or giving him $1 million. And I think the interviewer was thrown back saying, $1 million, a small loan of $1 million. What are you talking about, Donald Trump? People will never see that in their lifetime. The point I'm trying to make here is you don't need to start off with $1 million. You don't need to have a small or a massive fund. You can start off with just what you've got in your bank account right now. One of the easiest ways for beginners to dive into the world of investing is through index funds. Imagine an index fund as a smoothie that has a little bit of every fruit in the market. You don't need to pick the best fruits individually, you just get a taste of everything together. This way you spread out your risk and avoid the, oops, I put all my money in one fruit basket scenario. Index funds are great because they typically have lower fees and give you exposure to a wide variety of stocks. This means you're less likely to lose everything if one company has a bad year. It's a balanced way to start investing without the need to constantly monitor the stock market. If you don't know what index funds are, or you've never heard of ETFs before, exchange traded funds, then I strongly advise you to do some research as soon as possible to try and understand what these are and how they could potentially be your new vehicle to invest in. You want to know the magic secret sauce for every single successful investor? Is consistency. Yes, just like going to the gym, or at least pretending to, investing regularly is crucial. Whether it's monthly, bi-weekly, or whatever suits you, just keep it consistent and you will see the returns eventually. Think of it as feeding your money tree that we spoke about earlier. You don't want to dump a gallon of water on it once a year and hope for the best. A little bit of care and attention regularly, and boom, you've got yourself a flourishing money tree. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This way, you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost over time. You know, here at Wealth Hub IQ, we always give you practical tips and advice. So here's a practical tip for you. Automate your investments. Set up automatic transfers from your checking account to your investments account. If you're in UK, that's your current account to your investment account. This way, you won't even have to think about it. It just happens like magic. Voila. It's like putting your money on autopilot to the wealth destination. Just sit back, relax, and enjoy the ride while your money does all the heavy lifting for you. Most brokerage accounts and robo-advisors offer automated investment plans. Take advantage of these to ensure you're consistently investing and building your wealth over time without the hassle of manual transfers. So let's next talk about risk. Every investment comes with some level of risk. It's the nature of the game. But by understanding risk and diversifying your investments, you can manage that risk effectively. Diversification, don't let that word scare you. All it means is spreading your investments across different assets, industries, or geographical locations. So in layman terms, if you were to use the money tree example, we wouldn't only plant a money tree in one country, we'll plant it in multiple countries so that if the weather's bad in one country, hopefully the other weather would be good in the other countries to balance it out. Or if there was a war or a natural disaster, that one money tree may be affected, but all your other money trees would not be affected. Another simple example is, it's like not putting all your eggs in one basket. If one investment doesn't perform well, others might, balancing out the overall risk. For example, you might invest in a mix of bonds, stocks, and real estate or digital assets like cryptocurrency. Stocks offers potential growth, bonds provide stability, and real estate can offer both income and appreciation. And then digital assets such as cryptocurrency can provide the small fluctuations in your asset portfolio class, largely due to digital assets such as cryptocurrency's speculative nature. This way, you're not relying on a single type of investment to achieve your financial goals. I spoke about the secret sauce earlier, which was consistency. Now I'm going to talk about the magical sauce, that's compounding. And that is when your investments earn returns and then those returns start earning returns. It's like a snowball rolling down a hill, getting bigger and bigger over time, picking up more and more snow. The earlier you start investing, the more time your money has to grow and compound. Even small amounts invested regularly can turn into a substantial sum over a few decades. Let's say you invest £100 or $100 a month at an average annual return of 7%. After 30 years, you'd have over £120,000 or $120,000, even though you only invested $36,000. That's the power of compounding at work. And I'm really giving you free gems here because there are certain index funds, I will not mention any names, but there are certain index funds which have given these type of average annual returns. After 30 years of investing, you could have easily had these type of numbers. So why not start now? Why not start doing research into index funds, looking at certain index funds that provide a service that meets your requirements, and they're investing in stocks which again meet your requirements, whether that be morally or religious compliance. Make sure that each of the stocks are compatible with what you want in life. And what I mean by this, just to be a bit clear, is if you are against the selling of arms, ensure that you look into the index fund to make sure you're not actually investing in a company which purchases or endorses the selling of arms. Now we're going to talk about patience in investing. One thing that I've learned throughout my years of investing is that the stock market definitely isn't a get rich quick scheme, as I mentioned before. It requires patience and a long-term perspective. But I'd love to hear your thoughts on this. Do you think patience is the most underrated aspect of investing? Let me know in the comment section below. For me, understanding that there will be ups and downs, but staying committed to your financial plan is crucial. And there you have it, a beginner's guide to investing and building wealth. Remember, investing is a marathon, not a sprint. Start small, stay consistent, and watch your wealth grow over time. If you enjoyed this video, hit that like button, subscribe, and ring that notification bell for more tips on personal finance and investing. See you in the next video.